The AI bubble isn't just real, it's far worse than anyone is telling you. And the scariest part? Even the people making billions from it are warning you to get out. Sam Altman, the CEO of OpenAI, the company at the center of the entire AI boom, just said publicly that investors are overexcited and that someone is going to lose a phenomenal amount of money. Jamie Dimon, head of JP Morgan, the largest bank in America, warned that an AI-driven stock crash is coming. And Michael Burry, the guy who predicted the 2008 housing crash, is now betting against AI stocks. But here's what nobody is connecting. While everyone's focused on whether AI works or not, there's something far more dangerous happening behind the scenes. It's called circular financing, and it's the exact same scheme that destroyed the dot-com bubble in 2000. Here's how it works. Nvidia invests $100 billion into OpenAI. OpenAI then spends that money buying Nvidia chips. Nvidia reports this as revenue, and their stock goes up. But that's not real demand, that's just money going in circles. And this isn't happening with just two companies. Microsoft, Oracle, CoreWeave, AMD, they're all doing it. Over $1 trillion in deals where everyone is investing in everyone else and spending money back and forth. Meanwhile, OpenAI is projected to lose $14 billion in 2026 and won't be profitable until 2029. And a recent MIT study found that 95% of companies investing in AI are getting zero return. Zero. In this video, I'm exposing the 5 reasons why the AI bubble is about to burst, which stocks are most at risk, and exactly what you should do with your money before it's too late. Because when this bubble pops, it's going to make 2008 look like a practice run. But there's one thing about this AI boom that is by far the most dangerous, and yet almost nobody is talking about it. It's called circular financing, and it's the financial equivalent of paying yourself and calling it a salary. Let me explain exactly how this works, because once you see it, you can't unsee it. Picture this. You're Nvidia, and you just made tens of billions selling AI chips. But you have a problem. To keep your stock price growing, you need to show investors that demand for AI chips is exploding. So what do? You invest $100 billion into OpenAI. OpenAI takes that $100 billion and spends it on Nvidia chips. You just paid yourself, but on paper, it looks like you made $100 billion in revenue from a customer. Your stock goes up. Investors think demand is real, but it's not. It's manufactured. And it gets worse. Nvidia also owns 7% of CoreWeave, a cloud company that rents out Nvidia chips. Nvidia gave CoreWeave money, CoreWeave used it to buy Nvidia chips, and then Nvidia agreed to buy back any excess capacity that CoreWeave can't sell. So Nvidia is guaranteeing their own revenue by investing in their customer who buys their products. OpenAI has a $22.4 billion deal with CoreWeave for cloud services. But CoreWeave got that capacity by borrowing money against those same Nvidia chips. And who's backstopping that debt? Nvidia. The whole thing is a house of cards where everybody owes everybody else money, and it's all built on chips that haven't even been used yet. Oracle just committed $300 billion to build data centers for OpenAI over 5 years. That's $60 billion per year. But OpenAI's entire projected revenue for 2025 is only $13 billion. How are they going to pay Oracle $60 billion per year when they're only making $13 billion total and losing money? Here's the answer. They're not. The only way this works is if Oracle's stock goes up based on the announcement. Oracle uses that inflated stock value to borrow more money, and the cycle continues. It's financial engineering, not business. And the same thing happened in the dot-com bubble. Equipment vendors would give money to telecom companies. Telecom companies would use that money to buy equipment from those same vendors. Revenue looked incredible. Stock prices soared. Then in March 2000, reality hit, and $5 trillion in market value vanished in 2 years. Financial Times just published a diagram showing the web of circular deals between Nvidia, OpenAI, Microsoft, CoreWeave, Oracle, and AMD. It looks like a conspiracy theory board. Money flowing in every direction, equity stakes overlapping, revenue commitments that depend on other revenue commitments. Jay Goldberg, an analyst at Seaport Global Securities, called these deals very murky and questioned whether Nvidia is actually investing or just subsidizing demand for its own chips. He compared it to asking your parents to co-sign your mortgage, except in this case, your parents also own the bank and the house. The scariest part? This isn't happening with small startups. These are trillion-dollar companies. Nvidia is worth $5 trillion. Microsoft is worth $3 trillion. If this scheme unravels, it doesn't just hurt tech investors. It crashes the entire market, because 30% of the S&P 500 is now held by just 5 AI-related companies. That's the highest concentration in 50 years, higher than the dot-com bubble. But even if you believe these companies will figure it out, there's one problem that math can't solve: the profitability impossibility. This next financial reality I'm about to share is perhaps the most damning evidence that this bubble is about to pop, and yet most investors are completely ignoring it. It's the profitability problem. And when you run the actual numbers, the whole AI story falls apart. Let me start with OpenAI, since they're at the center of everything. OpenAI has committed to approximately $1 trillion in infrastructure deals. That's not a typo. $1 trillion. The Stargate project with Oracle and SoftBank is $500 billion. Oracle's 5-year cloud agreement is another $300 billion. Nvidia's partnership brings $100 billion for data centers. AMD is contributing another 6 gigawatts of GPU capacity. Now here's the question nobody's asking: how does OpenAI pay for this? To generate a modest 10% return on $1 trillion in infrastructure, OpenAI would need to make $100 billion per year in profit, not revenue, profit, as in, after all expenses, $100 billion hitting the bottom line. OpenAI's projected revenue for 2025 is $13 billion. They're burning through $2.5 billion in cash every 6 months. They're projected to lose $14 billion in 2026, and they don't expect to be profitable until 2029. So how do you go from losing $14 billion per year to making $100 billion in profit? You don't. It's mathematically impossible without either massive price increases that nobody will pay, or adoption rates that have never been seen in human history for any technology. And OpenAI isn't alone. A recent MIT study found that despite $40 billion in enterprise investment into generative AI, 95% of organizations are getting zero return. Zero. That means companies are spending billions on AI tools and seeing no improvement in productivity, no cost savings, no revenue growth. Nothing. Microsoft, Alphabet, Amazon, and Meta, the 4 biggest AI spenders, are seeing their depreciation expenses skyrocket. In the final quarter of 2023, these companies combined for $10 billion depreciation costs from their data centers. By September 2025, that number hit $22 billion. By September 2026, it's expected to be $30 billion. What is depreciation? It's the accounting recognition that these massive data centers lose value over time. They're expensive to build and expensive to maintain, and every year they become worth less. That $30 billion per year in depreciation has to come out of profits. And here's the kicker. Meta and Microsoft are expected to have negative free cash flow in 2026 after accounting for shareholder returns. That means they're spending more than they're making. They're burning cash to keep this AI dream alive. Goldman Sachs CEO David Solomon said he expects a lot of capital that was deployed that doesn't deliver returns. Amazon founder Jeff Bezos called the current environment kind of an industrial bubble. And Sam Altman himself said, people will overinvest and lose money during this phase. Let's look at one more example, CoreWeave. This company is at the center of the circular financing web. They've received billions from Nvidia and OpenAI. They've signed $22.4 billion in contracts. They're being valued at over $22 billion before their planned IPO. But here's the problem. CoreWeave reported $3.7 billion in current debt, $10.3 billion in non-current debt, and $39.1 billion in future lease agreements for data centers. That's $53 billion in total obligations. Their expected revenue for 2025 is only $5 billion. They claim to have $56 billion in revenue backlog, meaning future contracts. But those contracts are with companies like OpenAI, which can't pay them because OpenAI is also losing money. It's a chain of IOUs where everyone owes everyone else money that nobody actually has. Oracle is another disaster. They're earning just 14% gross margins on $900 million Nvidia cloud sales, compared to their typical 70% margins. CNBC reported that Oracle expects to lose considerable sums of money renting data centers to OpenAI, and they've already lost $100 million in just one quarter. This isn't business. This is a Ponzi scheme dressed up in billion-dollar deals and tech buzzwords. And the only way it continues is if stock prices keep going up, so companies can keep borrowing money to fund the losses. The second the music stops, everyone realizes there are no chairs. But it gets even worse because the people who should be protecting investors are ringing alarm bells. The institutional warnings. Here's something that should terrify every investor holding AI stocks right now, and it's not coming from random skeptics on the internet. The world's most powerful financial institutions are warning that an AI-driven crash is coming, and they're not being subtle about it. Let's start with the International Monetary Fund and the Bank of England. Both institutions issued warnings in late 2025 about the growing risks of a global market correction due to possible overvaluation of AI tech firms. The IMF's managing director, Kristalina Georgieva, drew direct comparisons to the dot-com bubble of 2001 and warned that a market correction could stunt global growth and weaken the economies of developing countries. Think about that. The IMF is saying that when the AI bubble pops, it won't just hurt tech investors in Silicon Valley, it will damage the entire global economy and hurt the poorest countries the most. Goldman Sachs released a report comparing the AI boom to how tech stocks looked in 1997, 2 full years before the dot-com bubble actually burst. They flagged 5 warning signs that investors should watch: peak investment spending, falling corporate profits, rising corporate debt, Fed rate cuts, and widening credit spreads. We're seeing all 5 right now. And here's what's important about that 1997 comparison. If we're at 1997 levels, that means we potentially have 2 more years of gains before the crash. So some investors might think, great, I'll sell before 1999. But here's the problem. Nobody knows when 1999 is. The bubble could pop tomorrow or 2 years from now, and by the time you realize it, it's already too late. Jamie Dimon, CEO of JP Morgan, said there's a higher chance of a meaningful drop in stocks over the next 2 years than the market is currently pricing in. He acknowledged that AI is real and will eventually pay off, but he compared it to cars and TVs, revolutionary technologies that generated enormous value for society, but most companies involved in them lost money. And then there's Michael Burry, the investor who famously predicted the 2008 housing crash and was portrayed in the movie The Big Short. In October 2025, it was revealed that his fund built short positions against both Nvidia and Palantir. He's literally betting that these companies will crash. When the guy who called the last major bubble starts shorting the market, you should pay attention. But here's what really concerns me. Sam Altman, the CEO of OpenAI, the man who has the most to gain from AI succeeding, even warns people. At a press dinner in August 2025, he openly said, "Are we in a phase where investors as a whole are overexcited about AI?" And followed up with, "Someone is going to lose a phenomenal amount of money." That's like the owner of a casino telling gamblers that the house always wins. Why would he say that unless he knows something that the public doesn't? Goldman Sachs CEO David Solomon echoed this, saying, he expects a lot of capital that was deployed that doesn't deliver returns. This is the CEO of one of the world's largest investment banks, telling you that money being invested in AI right now will be lost. When the insiders are warning you to get out, you should probably listen. And if all these warnings weren't enough, there's one more factor that makes this bubble uniquely dangerous: the market concentration risk. Here's something that makes this AI bubble far more dangerous than the dot-com crash, and most investors don't even realize it's happening. It's market concentration, and the numbers are absolutely terrifying. In late 2025, 30% of the entire US S&P 500 index was held by just 5 companies: Microsoft, Apple, Nvidia, Amazon, and Alphabet. That's the greatest concentration in half a century. It's higher than it was at the peak of the dot-com bubble, and it's even worse when you look globally. 20% of the MSCI World Index, which tracks stocks from 23 developed countries, is held by these same 5 companies. What this means is that if these AI stocks crash, they don't just hurt tech investors. They crash your retirement account, your index funds, your 401k. Because these companies make up such a massive portion of the market, there's nowhere to hide. The Magnificent Seven stocks, Apple, Nvidia, Microsoft, Amazon, Tesla, Alphabet, and Meta, comprise about 35% of the S&P 500's total market cap. During the dot-com bubble, the concentration was lower. That means this bubble is actually more concentrated and more dangerous than 2000. And here's the terrifying part: these companies' earnings growth is slowing. The Magnificent Seven's projected earnings growth for 2026 is 18%, which sounds good until you realize it's the slowest growth in 4 years. And it's barely better than the overall S&P 500, which is projected to grow at 15%. So you're taking on all the concentration risk and volatility of these mega-cap tech stocks, but you're not even getting significantly better growth rates than the broader market anymore. That's not a good risk-reward trade-off. Tony DeSpirito, Global Chief Investment Officer at BlackRock, tried to calm fears by saying, "These aren't dot-com multiples." And he's technically right. The NASDAQ 100 is trading at 26 times projected profits, compared to over 80 times at the height of the dot-com bubble. But here's what he's missing. Those dot-com companies had no revenue. They were pure speculation. Today's AI companies have massive revenue, massive profits, and massive cash flow. But they also have massive obligations. They've committed to spending over $1 trillion on infrastructure that may never generate returns. It's a different kind of bubble. Instead of companies worth billions with no revenue, we have companies worth trillions with huge revenue but commitments that exceed their ability to pay. It's not speculation on future potential. It's overcommitment to projects that the math says can't work. And because these companies are so large and so interconnected with the entire market, when they fall, they take everything with them. In the dot-com crash, most people's retirement accounts were fine because these companies weren't in every index fund. Today, if you own an S&P 500 index fund, a third of your money is in these 5 companies. The risk isn't that AI stocks crash. The risk is that when AI stocks crash, your entire portfolio crashes with them. So what does all this mean for you as an investor? What you should actually do now. Here's the reality that nobody else will tell you straight, and I'm going to give you the honest truth. For 90% of investors, the smart move right now is to reduce your exposure to AI stocks. not necessarily sell everything, but stop buying more and start diversifying. If you're heavily invested in Nvidia, Microsoft, or any of the companies in the circular financing web, consider taking some profits off the table. Not because AI isn't real or won't eventually succeed, but because the valuations have gotten ahead of reality. Here's a framework. If more than 30% of your portfolio is in the Magnificent Seven stocks, you're overexposed. Start rebalancing. Move some of that money into sectors that aren't dependent on AI hype: consumer staples, utilities, healthcare, international markets that aren't tied to US tech. Look at undervalued stocks with real earnings and cash flow. Companies like Sprouts Farmers Market, which trades at a forward PE under 16 despite steady growth, or Crocs, which has been beaten down despite strong fundamentals. These aren't exciting AI plays, but they're businesses that make money today, not theoretical profits in 2029. If you're in index funds, you can't avoid AI exposure entirely, but you can tilt toward equal-weighted S&P 500 funds instead of market cap-weighted funds. Equal-weighted funds don't have 30% in 5 stocks. They spread the risk more evenly. And here's the most important part: keep cash on hand. When this bubble pops, and history says all bubbles eventually pop, there will be incredible buying opportunities. The investors who survive bubbles aren't the ones who predicted the exact top and sold everything. They're the ones who had cash ready to buy when everyone else was panicking. Goldman Sachs CEO David Solomon warned of a likely 10-20% drawdown in equity markets within the next 2 years. If he's right, that drawdown is your opportunity to buy great companies at discount prices. But you can only do that if you're not fully invested in AI stocks that crash 50-70% when the bubble pops. Look, I'm not saying AI isn't real. I'm not saying these companies won't eventually succeed, but I am saying that the current valuations, combined with circular financing, unprofitable business models, and institutional warnings, suggest we're much closer to the end of this bubble than the beginning. Let me bring this all together and show you exactly what to watch for. So we've covered the 5 reasons why the AI bubble is worse than you think. The circular financing scheme that's manufacturing fake demand. The profitability impossibility where the math simply doesn't work. The institutional warnings from the IMF, Bank of England, and top CEOs. The market concentration risk that puts your entire portfolio at risk, and what you should actually do to protect yourself. These are the exact warning signs that wealthy investors are watching right now while everyone else is buying at the top. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't understand which specific stocks are most at risk and which ones might actually survive the crash. Without knowing how to separate the real AI companies from the bubble companies, you could sell winners and hold losers. Click this video over here where I break down exactly which AI stocks to avoid and which ones to buy when the crash happens. I'll see you in the next one.